Return on invested capital is one of the most important metrics to look at in a company. Now, fair warning on this video, it can feel very complicated. It will be very complicated. And I want you to understand that from my perspective, I'm still constantly learning about ROIC. So don't feel overwhelmed as you watch this video and think, I don't get this. Trust me when I say, I still have tons of questions and I did not understand ROIC when I first started. But here's why it's important. So there are two ways to fund a business. You can either borrow money or you can put your own money in, which is equity. That's the two amounts of money that are put into a business to get it rolling, okay? If you want no debt, you just write a check. So what is ROIC? ROIC is the return you're getting on the invested money in the business through debt and equity, all right? So you've probably heard the term weighted average cost of capital, WACC, all right? So when you have debt and equity, your weighted average cost of capital is the weighted return you need to get to honor these. So for example, if you have no debt in a company and you have all the money coming from equity and your equity investors require a 10% return, your weighted average cost of capital is 10% times 100%, which is 10%. What that means is the company needs to be able to invest at higher rates of return than 10% in order to build value in the business, okay? Let's go the other way. Let's say it's 100% debt and 0% equity. So every single piece of money in the business is borrowed money. And your debt investors require a 6% return. Now, your weighted average cost of capital is 6%. You need to get above a 6% return to cover your debt holders. Now, usually what happens is it's somewhere in the middle. Let's say it is 40% debt and 60% equity, all right? And your debt holders require 6%, that's what you pay them, and your equity holders require 10%. Well, 40% of 6% is 2.4%, and 10% of 60% is 6%, right? So 10% times 60 and 6% times 40. Your weighted average cost of capital is 8.4%, 2.4 plus 6. What this means is you need to get 8.4% return on your money to create wealth. If you get below that, you're not giving the equity holders enough and you're not giving the debt holders enough to justify those returns. And that's why return on invested capital is important. You need to be able to get above your weighted average cost of capital in order to generate good returns. If not, you will see this in companies that have less than their weighted average cost of capital. They have to pay out the money to their investors in a dividend because they're really terrible about reinvesting the money in the business, okay? That's the general idea. So there are lots of companies out there with very low returns on invested capital. You're probably not going to get that much better return on the company than what the underlying business makes through its return on invested capital. So as an example, if you find a company where the return on invested capital is 5%, okay? If you find that the underlying business is basically making 5% of its money, that's probably what it's going to make in the long run if you pay a reasonable price for it, all right? But you'll find that Warren Buffett and Charlie Munger are very interested in finding companies with very high rates return on invested capital. Why? Here's the main reason why. So let's say there's two companies out there, Company A and Company B. Company A has a 10% return on invested capital and Company B has a 20% return on invested capital, okay? In order to grow, this company only needs to invest half the money to grow the business than Company A, right? Because their return on invested capital is higher. So let's say they both make $1,000 a year, okay? If they want to grow 10%, what does this company have to invest in order to get that growth? All the money. Because in order to get the 10% growth, they just need to invest $1,000 of their money to get that 10% growth. But what does Company B need to invest to get 10%? Well, half this amount, $500. So they just need to invest another $500 and they get 10% growth. This company has to invest the full $1,000. So Company B now has an extra $500 to pay down debt, pay out to shareholders with the dividends or to buy back shares. This company's got to invest every single dollar just to keep that 10% growth going. And even though we talk about revenue growth a lot in our channel, this is why it's important to look at return on invested capital. Because the higher the return on invested capital, the more money the company has at the end of the day to invest it back into the business, pay down debt, pay you as a shareholder by paying dividends, or to buy back shares. That's why ROIC is very important. That is why you need to pay a higher premium for high ROIC businesses. You should be willing to pay more for businesses that have high ROIC. So what's a reasonable return on invested capital? Well, the market overall will do about 10% on average. So businesses that are below 10%, you got to buy them dirt cheap. Dirt cheap. It's not possible to grow at high rates with a low ROIC unless you take on more and more debt or more investors. And then you're just depleting wealth. You're actually hurting the business because you're giving a high weighted average cost of capital, but getting a low return. That is not wealth generation, that's wealth destruction. But if you have a high ROIC, you can sit there and take your internal cash flow to grow the business. You don't have to take on more debt. You don't have to take on more equity holders. You can literally use your own cash flow to grow the business and use that extra cash flow to even decrease the debt holders and decrease the equity holders by buying back shares or paying down debt. That is the beauty of a high ROIC. So how do you calculate it? Well, guys, I hate to break it to you, but there are so many different ways to calculate ROIC. And you might sit there and say, that doesn't make sense. I know. It doesn't make sense. We're actually in our software changing the way we calculate ROIC because I'm finding better and better ways by using things that I've read, other companies, how they calculate it, other investors and how they calculate it to find a way that makes sense to me. What I'm going to do is in our software here, on everythingmoney.com, I am going to sit here and look at the 1 year and 5 year ROIC. Why look at 1 and 5 years? Well, I want to look at 5 years to see what do they make on average? And is the recent 1 year a fluke or not a fluke? Because there are ups and downs in the market cycles and your entire economic cycles. But I want to look at the long-term average. Is their ROIC increasing or is it decreasing? A high ROIC will show that a business has a strong moat. And the big thing in ROIC is you want to look at it and say, does it take a lot of capital to keep the business going? Look at the auto industry, for example. Ford and GM have very terrible returns on invested capital. And the problem is with that, they're very high capital intensive business. They need a lot of reinvestment in order to keep the business going. That's why Ford and GM, if you go look at their returns over a long period of time, they stink. So look at Ford, for example. Look at the stock price going back to 1988. It's pretty much the same. It's a very low return with a very high cost to put capital money into place to build factories, to do all these things. But then look at a company like Microsoft. Microsoft has a very high return on invested capital. Software businesses tend to. Why? They're not as capital intensive. You use the money from the business to go create more software. Once the software is created, it doesn't take as much to keep it maintained, and that gross margin is very, very high. Now, does that mean you shouldn't buy car companies and you should only buy software businesses? Absolutely not. And Charlie Munger has said before, in the long run, even if you pay more than you should for a business with high return on invested capital, you'll probably make that ROIC as your return. Now, if it was that simple, you just go filter by the highest ROICs and buy those companies. No, you can still overpay for a good thing. And you would say, hey, avoid low ROIC businesses. Well, IBM's low ROIC, but Berkshire's had them in the past. So it's still, if I could offer you to buy IBM for $1, would you do it? Absolutely. You're going to get a huge return on your money, even though the ROIC is lower. And if I told you to pay $10 trillion for Microsoft or Apple, would you do it? No, because if you overpay, you still takes a long time, even with a high ROIC, to make that money back. But ROIC, return on invested capital, is a great way to see how is the business run. Look at the airline industry. Airline industry sucks overall, but you have a company like Southwest, which is able to make good returns and sit there and because they stay very focused. I don't think their ROIC is very high. In fact, let's take a look at it right now. But you can sit there and buy it for a reasonable price. You can still make good money. Yeah, look at this. Very low return on invested capital. 5.2%. But look at their stock overall, big gains. Why? They're going to sit there and they're going to pay out dividends, which they used to do before COVID. And that's why it's not just about ROIC, but it probably is one of the most important aspects to look at a business, because if you want the multi-bagger, a high ROIC is the one that's going to give you a more likelihood of hitting that. Because if they can invest small amounts of money into their business to generate higher and higher returns, they're going to grow their earnings per share and their cash flow at much easier and much higher rates. And that's how they'll generate more and more money. For a company like Southwest with a low ROIC, you have to be ready for a lot of dividends and doing that in order to grow, in order to get a big return on your money. So I'm not opposed to low ROIC businesses, but I've got to pay a cheaper price, a lower multiple of earnings and cash flow, because it might require a lot of reinvestment and I'm not going to have as much opportunities for reinvestment in the company. So again, if this is confusing, rewatch the video, watch the portions, because investing is an art. There's no direct do this and you'll always win. No, that's not possible. But if you're going to err on the side of something, focus on high ROIC businesses, especially if you want to compound your money over time. But again, look at Apple. Apple's a high ROIC business that Buffett and Munger love. But guess what? Apple's got very, very, very little growth rates, but a very high return on invested capital. So Munger and Buffett are probably sitting there saying, listen, if they do find some growth opportunities, it won't take much capital to go invest in those and generate high returns. And if they don't, they're going to have a lot of free excess cash to go buy back shares, pay down debt, and pay out to shareholders. And I think that's the play that Warren Buffett and Charlie Munger are making on Apple. Now, Mo and I have a much lower price on Apple than Buffett and Munger do. Are we right? I don't know. They also have a lot more money, and it's hard for them to find good opportunities for them to invest $100+ billion. But for me, I look at the low growth rate, and yes, they have a high return on invested capital, but clearly that's not really generating a lot of growth potential. And it takes when you have a $2 trillion company, it takes quite the reinvestment to be able to really move the needle. And that's part of the healthy balance of asking questions about a certain company here or there. If it was as simple, like I said, if it was as simple as just looking at high ROIC, you just sort by ROIC and buy the top companies. But it's not that simple, because highest ROIC company at 10 trillion versus the lowest ROIC at $1, I'm probably taking the one at $1. And that's the whole idea of value investing. It's not just about what you're getting, it's what you're paying. That's the most important part. What are you paying for that? Now, can a high ROIC business justify a high teens or low 20 PE, a price of free cash flow? Sure, maybe so. But can a low ROIC business justify that? No, that's the hard part. And when you start finding a situation with a low ROIC and a high multiple, that's a red flag. And that's kind of the thing I want you to focus on. I want you to focus on, wait, low ROIC, high multiple. Nope, I'm going to ignore that. And even if it's growing fast, if it's a low ROIC, how sustainable is that? That's the question you have to ask. How sustainable is it to have a lot of revenue growth? I would start looking at the company and saying, hey, how did they grow? Are they making acquisitions, or are they growing organically or through reinvestment? Because it's really difficult to have high growth and low ROIC. It's difficult to make real good economic profit doing that. So the quick recap is, don't only look at this metric, but it's a good way to filter out to find the multi-baggers. Go look at high ROIC businesses that you can sit there and they can reinvest their money and have excess cash to pay you back as an investor. So if you like this video, subscribe to the channel, because I guarantee if you watch 4 or 5 more of our videos, you will become a better investor, because the more you learn, the less you fear. Thank you very much. There are 3 things that you absolutely need in order to be a successful investor: the proper mindset, the proper emotion, and the proper process. Which ones are the most important?